Good morning, everybody. Today, I'm planning to discuss one question relating to preparation of final account under F3. This question specifically deals with calculation of depreciation and adjustments relating to property, plant, and equipment. This is a typical question, comes in F3 level at a basic accounting, and also this may be suitable for other students who prepare basic accounting examination purposes. Let's go to the question. Now, if you see here, the following list of account balances was extracted from the ledger of Roger Jones, a sole trader, as of 31st May 2001, the end of his financial year. Roger Jones' trial balance as of 31st May 2000X1, property at cost, equipment at cost, accumulated depreciation, and so on. They are giving so much of different information, and they're also giving you additional information as of 31st May 20X1 is available. Inventory as at the close of the business has been valued at cost at 42,000. Depreciation for the year under 31st May 20X1 has still to be charged as follows. Property 1.5% per annum using the straight line method. Equipment 25% per annum using the reducing balance method. Required. Prepare Roger Jones' statement of profit and loss for the year under 31st May 20X1 and his statement of financial position as at that date. Let's try this question. In trying this question, we need to set up the format. The format will be statement of profit and loss account and statement of financial position. Some other information you may have to write, like the date and the name of the entity, which I am not writing here. Let's put down the format. Sales minus cost of sales, opening stock plus purchases, then minus closing stock. I will deliberately leave 2 or 3 lines if we have to have any other additional information to fit into that space. So then this is gross profit. Then again I will leave some space for the possibility of having any other income. Then minus expenses. We will have enough space for that as well. So this is the profit and loss account, and we also have statement of financial position. We start with assets, then non-current assets. Under that, we will have property, plant, and equipment, and then we may have other type of long-term non-current assets, which I will leave space, and then we take the total here. Then we have the current assets. So current assets, possibly we may have several current assets. Then we have the total in this manner here. This is the total assets. Then we have equity, and liability. Under that equity, there you have share capital. Actually, this is a sole trader business, so capital plus profit minus drawings. Then you take that, and then we have liabilities, non-current liability, current liability, and we take the total. This is total equity and liability. So this is the format. So once the format is laid out, we will then go to the question again. Remember, when you're reading a question of this nature, this is called an essay type question, we have to first complete the adjustment. The very first adjustment is, or additional information, the following additional information as at 31st May 2001 is available. Inventory as at the close of the business has been valued at 42,000. So, first additional piece of information is inventory. They say 42,000. For this 42,000, adjustment which we need to require is to subtract the 42,000 under the calculation of cost of sales. Note that this is under cost of sales. We are taking this closing stock here. And then we come to current assets and we consider that as the closing inventory as one of our current assets and we take it here. So in other words, if you think the double entry for this, there is a debit. There's a debit for the inventory. There is a debit for the inventory and there's a credit in the cost of sales. So that is the first adjustment. Second one, depreciation for the year ended 31st May 2001 has still to be charged as follows. So they have given you property 1.5% per annum using the straight line method and equipment 25% per annum using the reduced imbalance method. So we will calculate that. So second adjustment number 2, depreciation calculation. Here, property. They said 1.5% straight line method. We have to find out what is the cost of the property. The property cost is 120,000. So 120 into 1.5%. Let's work out. So 120,000 into 1.5%, which is 1,800. So that is your depreciation for the year. The double entry for this, you need to debit depreciation expense and credit accumulated depreciation. So that is property. Next part of the adjustment is equipment. Equipment, they said 25% reducing balance method. In this case, we need to find out the cost of the equipment first of all. Equipment cost 80,000. Cost 80,000. So far accumulated depreciation we need to know prior to calculating the depreciation. That is 38,000. That is 38,000. So what you do now, you subtract this two. 80,000 minus 38,000 into 25%. So the depreciation, so this is 42,000 So the depreciation will be 25% of this, and that will be 10,500. So the total depreciation expense $1,800 coming from property and 10,500 coming from equipment. So the total of these two will be 1,800 plus 10,500, 12,300. So what we do now, we go back to our format of P&L. Under expense, we will take depreciation, and that depreciation is coming to 12,300. And we come back to the non-current asset property. We have the first property is property. So property, we need to split this, and here the cost, accumulated depreciation, and net book value. The property cost is 120, and the depreciation, we have to find out the previous depreciation in the trial balance that should be available, 20,000. So therefore, depreciation will be plus 20. So 21,800. So then the net book value will be 120 minus 21,800, 98,200. Equipment. Cost of the equipment is 80,000. And accumulated depreciation will be this plus 38,000. So that is 10,500 plus 38,000, 48,500. So 48,500. Now what we do, we find out the difference in this. So the difference there, 80,000 minus 48,500, 31,500. So we can now take this total here, 200,000 and 21,800 plus 48,500. 21,800 plus 48,500, 70,300. So therefore, 200,000 minus 70,300. 70,300. 129,700. 129,700. So we need to make sure the total also equal on a vertical basis, so that if you subtract 98,000, so you should get 31,700. You are getting it. 98,200. That's okay. Now we go to the trial balance. So now that we have done all the adjustment, we just simply fill the information available in the trial balance. We have taken property already done, equipment already done, accumulated depreciation already dealt with, purchases. How much? 250,000. Purchases 250,000. Then we have sales 402,200. 402,200. That is the sales. Then we have purchases, sales, inventory, opening stock 50,000. Opening stock 50. After inventory, returns out, purchase returns 15,000. So minus purchase return 15,000. So you subtract that. Then what you have? Wages and salaries 58,800. Wages and salaries 58,800. What else you have? Selling expense 22,600. Selling expense 22,600. Then you have loan interest 5,100. Now, when come to loan interest, you need to do one additional test. So the loan interest here, they said 5,100. We need to check the loan balance in the TB. The loan balance in the TB is 30,000. 30,000 and 17% interest. We need to find out how much is this. See, in this case, it is coincident that the calculation of interest and the amount we paid was same. Suppose if this is different, then we have to do some additional adjustments. So, loan interest 5,100. Next one, other operating expenses 17,700. Other operating expense 17,700. Then you have trade accounts payable 36,000. Accounts payable 36,000. Then you have trade accounts receivable 38,000. Receivable 38,000. Cash in hand 300. Cash at bank 1,300. Cash at bank, we have to write first 1,300 and cash 300. Remember, this is the liquidity order. Then drawings 24,000. So drawings you have to take it here 24,000 minus. And then 17% long-term loan 30,000. That's a non-current liability. Long term loan 30,000. And the very last item, capital 126,600. 126,600. Now what we do is we use the calculator and we work out the cost of sales. So we take this total here. So we need to take the total of 5250 minus 15. So 50,000 plus 250,000 minus 15,000, 285,000. 285,000 minus 42,000. That is 243,000. 243,000. This is the cost of sales. So 402,200 minus 243,200 minus 243,000. 159,200. This is the gross profit. No other income. So the gross profit is still 159,200. Then we will take the total of all this. 12,300 plus 58,800 plus 22,600 plus 5,100 plus 17,700. 116,500. So that is the total expense. So net profit will be 159,200 minus 116,500 minus 159,200. 42,700 is the net profit. 42,700. Now 42,700 must be added here. Now we come to take the total of all the current assets. 42,000. Stocks. Receivable 38,000. Plus cash at bank, I guess 1,300. And cash 300, 81,600. And no other non-current asset there. So 129,700 plus 81,600. 211,300. 211,300. Here we take the total of 126,600 plus 42,700. 169,300 minus 24,000. 145,300. So 145,300 here. Non-current liability, no other totals, 30,000, and this is 36,000. So plus 211,300. And that's how you do what you call final accounts with these type of adjustments. Thank you very much. Thank you for watching the video, and I will be sharing more videos time to time. And kindly like my videos, share it, and as well subscribe to benefit on this type of videos again. Thank you.